Australia's housing market is entering another phase of pressure. Interest rates remain elevated, mortgage repayments are rising, and across Western Sydney, several suburbs are now showing early signs of repayment stress. Here's the number that matters. More than 62,000 fixed-rate mortgages across New South Wales will reset in 2026. Most of these loans were written between 2020 and 2021, when mortgage rates were between 2% and 2.5%. Today, the average variable mortgage rate sits between 6.4% and 6.9%. That means repayment increases of $1,600 to $2,100 per month for many borrowers, up to $25,000 per year in additional mortgage costs. But this pressure is not evenly distributed across Sydney. Mortgage stress is becoming geographically concentrated, and several Western Sydney suburbs are now sitting at the center of that pressure. In this video, we're going to break down 5 suburbs where mortgage stress risk is rising fastest. Blacktown, Liverpool, Parramatta, Penrith, Campbelltown. Each suburb represents a slightly different part of Sydney's housing system, but they share one common factor: high mortgage exposure during the ultra-low interest rate period. Let's start with Blacktown. Blacktown sits in the heart of Western Sydney's growth corridor. Over the last decade, it has absorbed large volumes of population growth. Median house prices in Blacktown currently sit around $900,000 to $930,000. During the pandemic housing boom, thousands of first-home buyers entered the market here. Many secured loans when interest rates were near historic lows. At a rate of 2.2%, an $800,000 mortgage required repayments of roughly $3,050 per month. At 6.7%, that same loan requires repayments closer to $5,200 per month. That is an increase of more than 70%. The economic mechanism here is simple. When mortgage repayments rise that quickly, household cash flow contracts, disposable income falls, consumption slows, savings buffers shrink, mortgage stress begins to increase. Recent housing surveys suggest roughly 28% of borrowers in parts of Western Sydney are already spending more than 35% of their gross income on mortgage repayments. That level is commonly used as a stress threshold in housing economics. Next suburb, Liverpool. Liverpool experienced strong housing demand during the pandemic period. Several factors drove that growth: population migration, infrastructure investment, and relative affordability compared with inner Sydney. Median house prices currently sit around $820,000 to $860,000. But Liverpool also saw heavy investor participation between 2020 and 2022. This matters. Investors behave differently from owner-occupiers. When interest rates rise above rental yields, investors often move toward selling. Rental yields in many Sydney suburbs sit around 3% to 4%. Mortgage rates today sit above 6%. That creates negative carry. When capital growth slows at the same time, investors reassess their positions. This is one reason listings can rise quickly in leveraged suburbs. Now let's move to Parramatta. Parramatta has been positioned as Sydney's second central business district. Government offices, corporate headquarters, and major infrastructure projects have expanded the area's economic footprint. Median house prices are now close to $1.1 million to $1.2 million. But higher property values also mean larger mortgage balances. This creates a different type of risk. A borrower with a $1 million loan moving from 2.3% to 6.7% interest can experience repayment increases exceeding $3,000 per month. In other words, the absolute repayment shock becomes larger even if incomes are higher. That is the structural exposure in higher-priced suburbs. Next suburb, Penrith. Penrith has seen rapid price growth over the past 4 years. It became a major destination for buyers priced out of Sydney's inner and middle rings. Median house prices currently sit around $760,000 to $800,000. But many buyers entered the market with relatively small deposits. High loan-to-value ratios mean households have smaller equity buffers. If prices stall or decline even slightly, refinancing flexibility can become limited. Banks assess refinancing partly based on current valuation and equity position. If equity shrinks, borrower options shrink with it. Finally, Campbelltown. Campbelltown remains one of the more affordable housing markets within Sydney's metropolitan region. Median house prices sit around $700,000 to $730,000. However, household incomes in this region are also lower than Sydney's inner suburbs. This means repayment increases consume a larger share of income. An extra $1,800 per month in mortgage repayments can represent a much larger percentage of household income in these areas. That is why mortgage stress tends to appear first in outer growth corridors. Now let's step back and look at the broader economic mechanism. Mortgage stress does not usually begin with immediate defaults. Instead, it develops through stages. Stage 1 is expense compression. Households reduce discretionary spending. Dining out declines. Retail purchases fall. Local service sectors feel the slowdown. Stage 2 is liquidity drawdown. Borrowers use savings buffers. Offset balances shrink. Our redraw facilities become active. Stage 3 is refinancing attempts. Borrowers approach banks seeking lower rates or extended loan terms. Some switch to interest-only repayments temporarily. Stage 4 is distress resolution, either a voluntary sale or, in more severe cases, arrears. However, refinancing depends heavily on property valuations. If prices stop rising or begin falling, loan-to-value ratios increase. That can limit refinancing options. And now let's compare this situation with Brisbane. Brisbane has experienced strong housing growth in recent years. However, median house prices remain significantly lower than Sydney. Brisbane's median house price currently sits around $850,000 to $900,000. Loan sizes are therefore smaller. Migration from other states has also supported demand. Population growth helps absorb new housing supply. This creates a different risk profile compared with Sydney. Now consider Perth. Perth's housing market has benefited from strong population inflows and resource sector employment. Median house prices remain below Sydney levels. Mortgage balances are therefore smaller. That reduces the absolute size of repayment shocks. Even when interest rates rise, the monthly increase tends to be lower. Finally, Adelaide. Adelaide has seen steady price growth but maintains one of the more affordable housing markets among Australia's major cities. Lower median prices mean lower leverage. Yet lower leverage means less exposure to interest rate shocks. Sydney, by contrast, sits at the extreme end of the price spectrum. Median NSW house prices remain around $1.18 million. Higher prices mean larger mortgages. Larger mortgages mean larger repayment increases. That is the structural vulnerability. Now consider the policy dimension. The Reserve Bank of Australia controls monetary policy. The RBA cash rate currently sits around 4.35%. Mortgage rates follow this benchmark. State governments have limited direct control over interest rates. NSW Premier Chris Minns has focused largely on housing supply reforms, planning approvals, higher density targets, infrastructure investment. These policies address long-term supply shortages, but they do not immediately change mortgage repayment arithmetic. That creates a timing mismatch. Supply reforms operate over years. Mortgage resets occur over months. Now let's model potential outcomes. Best case scenario. Or inflation falls faster than expected. The Reserve Bank cuts interest rates by 0.75% to 1%. Variable mortgage rates fall closer to 5.5%. Borrowers refinance into more manageable repayment structures. Mortgage stress stabilizes. Property prices in Western Sydney remain broadly stable. Worst-case scenario: inflation remains persistent. Interest rates remain near current levels through 2026. Borrowers reaching the fixed-rate reset experience full repayment shock. Listings increase across Western Sydney. Distressed sales rise. Property prices in some suburbs decline 10% to 15%. Negative equity expands among recent buyers. Most realistic scenario: a contained stress cycle. Listings increase moderately. Days on market extend. Price growth stalls or softens slightly in outer suburbs, but the national housing market remains broadly stable. Localized corrections appear in leveraged areas. Now let's recap the core numbers. At approximately 62,000 NSW mortgages reset in 2026. Repayment increases could reach $1,600 to $2,100 per month. Some borrowers already exceed the 35% mortgage stress threshold. Median house prices remain around $1.18 million in New South Wales. Variable mortgage rates remain near 6.5%, and mortgage exposure remains heavily concentrated in specific suburbs: Blacktown, Liverpool, Parramatta, Penrith, Campbelltown. This does not necessarily imply a national housing crash, but it does highlight localized vulnerability. When large mortgage balances meet sustained high interest rates, pressure concentrates quickly, and Western Sydney currently sits at the center of that pressure. If interest rates remain elevated into 2026, these suburbs will likely be the front line of Australia's next mortgage stress cycle. Now let's step back and examine a deeper structural question. Why has Western Sydney become one of the most leveraged housing corridors in the entire country? The answer lies in a combination of three forces: population growth, housing affordability constraints closer to the CBD, and ultra-low interest rates during the pandemic period. Between 2019 and 2023, Western Sydney absorbed a large share of Sydney's population expansion. New infrastructure projects, including the Western Sydney Airport and major transport upgrades, also increased long-term expectations for the region. As a result, suburbs like Blacktown, Liverpool, Penrith, and Campbelltown became major entry points for first home buyers. But this demand surge happened at exactly the same time as record-low borrowing costs. Mortgage rates fell below 2.5% in many cases. Lower rates dramatically increase borrowing capacity. For example, when interest rates fall from 5% to 2%, a household's borrowing capacity can increase by roughly 30% to 40%. This is why property prices surged so rapidly during the pandemic period. But the reverse mechanism also applies. When interest rates rise, borrowing capacity contracts. That contraction becomes most visible in markets where households are already highly leveraged. Western Sydney fits that profile. Now consider the national debt picture. Australia already carries one of the highest household debt-to-income ratios in the developed world. Household debt now sits at roughly 180% of disposable income. A large portion of that debt is concentrated in residential mortgages. Sydney, as Australia's most expensive housing market, holds the largest share of that exposure. And within Sydney, the outer growth corridors carry the highest relative leverage. This is why mortgage stress rarely appears evenly across a city. Instead, it clusters geographically. High-debt suburbs tend to move together. Let's examine how this stress spreads through the housing system. Mortgage stress does not automatically translate into immediate property market declines. Instead, it operates through a sequence of market adjustments. The first adjustment appears in household consumption. When borrowers face higher mortgage repayments, discretionary spending declines, retail spending slows, hospitality revenue weakens, and local small businesses feel pressure. This stage does not affect house prices immediately, but it signals that household financial buffers are shrinking. The second adjustment appears in housing listings. Some borrowers decide to sell voluntarily before financial pressure becomes severe. Listings begin to rise. This increase in listings usually appears first in the most leveraged suburbs. If new listings begin to outpace buyer demand, the market balance shifts. Days on market increase. Vendor discounting becomes more common. Auction clearance rates decline. This is how micro-corrections begin. Importantly, these corrections often occur at the suburb level, not nationally. Now compare this mechanism with Brisbane. Brisbane has experienced strong interstate migration over the past several years. Population growth supports housing demand. Rental vacancy rates remain relatively tight, and median home prices remain lower than Sydney. Lower prices mean lower mortgage balances. Lower balances mean smaller repayment increases when interest rates rise. That structural difference matters. Now consider Perth. Perth's housing market has been supported by resource sector employment and relatively strong wage growth. Median property prices remain well below Sydney levels. Loan sizes are therefore smaller. Even when interest rates increase, the absolute repayment shock is lower. As a result, Perth's housing market currently shows fewer signs of widespread mortgage stress. Now let's look at Adelaide. Adelaide has experienced steady housing growth over the past decade, but its housing market remains more affordable compared with the eastern capitals. Lower entry prices reduce leverage risk. Lower leverage reduces vulnerability to interest rate shocks. Sydney, by contrast, sits at the extreme end of the affordability spectrum. Median prices remain above $1 million. That means Sydney borrowers carry larger debt balances than most Australian households. And when interest rates remain elevated, those larger balances amplify financial pressure. Now let's consider another important variable: unemployment. Western Sydney contains a large concentration of workers in sectors such as construction logistics, retail, transport, manufacturing. These industries are more sensitive to economic slowdowns. If broader economic activity weakens, employment softness may appear in these sectors first. If unemployment rises even slightly, mortgage stress can accelerate. This is because employment stability plays a critical role in mortgage servicing. When income declines, repayment stress intensifies rapidly. This creates a potential feedback loop. Higher interest rates reduce household spending. Reduced spending slows business activity. Slower business activity affects employment. Employment pressure increases mortgage arrears. Mortgage arrears increase distressed property listings. So more listings increase supply in the housing market, and increased supply places downward pressure on prices. This chain reaction does not occur instantly, but it represents the underlying mechanism through which housing corrections develop. Now let's quantify potential impacts. If only 5% of the 62,000 resetting loans enter serious repayment difficulty, that represents more than 3,000 distressed properties. If 10% reach that stage, the number rises above 6,000 properties. Spread across several suburbs, that level of supply could materially shift market conditions. To put this into perspective, some Western Sydney suburbs record only 200 to 300 property sales per month. An additional 200 distressed listings per month could significantly alter local market dynamics. This is why mortgage stress is fundamentally a localized phenomenon. It does not need to spread across the entire country to affect property prices. Now let's examine the role of investors. Western Sydney saw significant investor activity between 2020 and 2022. Many investors purchase properties expecting continued price growth, but investors are typically more sensitive to interest rate changes than owner-occupiers. When borrowing costs rise above rental yields, holding costs increase. Rental yields in many Sydney suburbs sit around 3% to 4%. Mortgage rates now sit above 6%. That means many investment properties operate at negative cash flow. If property prices stop rising, investors may decide to exit the market. This adds additional supply pressure. Now consider the policy dimension. State governments can influence planning approvals and housing supply, but monetary policy remains controlled by the Reserve Bank of Australia. The RBA's primary objective is controlling inflation. If inflation remains above the target range, interest rates are unlikely to fall quickly. This creates a structural challenge for housing markets. Supply reforms take years to affect housing availability, but mortgage resets occur within months. That timing mismatch is critical. Now let's look at forward scenarios. Best case scenario. Inflation declines faster than expected. The Reserve Bank begins gradually lowering interest rates. Mortgage rates fall toward 5.5%. Borrowers refinance successfully. Mortgage stress stabilizes. Property prices remain broadly stable. Worst case scenario. Inflation remains persistent. Interest rates remain elevated through 2026. Borrowers face sustained repayment increases. Listings rise sharply in leveraged suburbs. Property prices in parts of Western Sydney fall 10% to 15%. Negative equity begins affecting recent buyers. Most realistic scenario. Mortgage stress rises but remains manageable. Listings increase moderately. Housing price growth slows or stalls. Localized corrections occur in highly leveraged suburbs. But the national housing market remains broadly stable. Now let's recap the key statistics. Approximately 62,000 mortgages across New South Wales reset in 2026. Repayment increases could reach $1,600 to $2,100 per month. Around 28% of Western Sydney borrowers already exceed the 35% mortgage stress threshold. Median NSW house prices remain around $1.18 million. Variable mortgage rates remain near 6.5%, and the highest leverage exposure remains concentrated in 5 key suburbs: Blacktown, Liverpool, Parramatta, Penrith, Campbelltown. The mortgage stress does not always trigger immediate housing crashes, but when large debt balances meet sustained high interest rates, financial pressure builds quickly. And right now, Western Sydney sits at the center of that pressure. If interest rates remain elevated into 2026, these suburbs may become the front line of Australia's next housing adjustment cycle. Subscribe so you don't miss the next analysis. Thanks for watching.